When you're running a business, the best days are the ones where priorities stay on track. For midsize and large companies, that isn't always easy. Risk can touch multiple parts of an organization at the same time, often in ways that aren't immediately obvious. It might involve property, liability, or cyber. It could stem from regulatory requirements or challenges tied to a specific industry or the scale of an operation. At that level, managing risk becomes an ongoing discipline, not a one-time decision. At The Hartford, the focus is on helping businesses manage risk before it turns into something more disruptive. That means working with companies to identify where they're exposed, decide what matters most, and put practical standards in place so risk is managed as part of day-to-day operations. And when losses do happen, The Hartford can pair that risk control work with insurance coverage grounded in underwriting, risk engineering, and claims experience developed over time. Learn more at thehartford.com/risk mitigation.
So there's a lot of noise about AI, but time's too tight for more promises. So let's talk about results. At IBM, we work with our employees to integrate technology right into the systems they need. Now, a global workforce of 300,000 can use AI to field their HR questions, resolving 94% of common questions. Not noise, proof of how we can help companies get smarter by putting AI where it actually pays off, deep in the work that moves the business. Let's create smarter business. IBM.
When you own your own business, you own every decision. Now own the card that rewards you for it. Chase Sapphire Reserve for Business is a pay-in-full card that elevates your travel experience and offers premium benefits that will take your business to the next level. Sapphire Reserve for Business offers 8x points on all purchases through Chase Travel, 3x points on social media and search engine advertising, airport lounge access, and more. Chase Sapphire Reserve for Business. It's the card that gives back all you put in. Learn more at chase.com/reserve business. Chase for Business. Make more of what's yours. Account subject to credit approval. Restrictions and limitations apply. Cards are issued by J.P. Morgan Chase Bank, N.A. Member FDIC.
Welcome to Inside Active, a podcast about active managers that goes beyond soundbites and headlines and looks deeper into their processes, challenges, and philosophies in security selection. I'm David Cohne. I lead mutual fund and active research at Bloomberg Intelligence. Option-based income ETFs are no longer just a niche income tool. They become a major part of the active ETF conversation, with advisors using them to solve for income, equity exposure, tax efficiency, and portfolio construction in different ways. That growth has also made the category more complicated. Investors now have to look beyond headline distribution rates and understand how each strategy generates income, how much equity participation it preserves, and what trade-offs are being made, and what the after-tax outcome may look like. So today, I wanted to explore how options income category is evolving, how tax-aware implementation is shaping the next generation of strategies, and how advisors are thinking about the role of these ETFs that they can play in client portfolios. So joining me to discuss that is Wes Mathews, Senior Managing Director and Head of Investment Strategy at NEOS Investments. Wes, thanks for joining me.
Thanks, David. Appreciate you having me.
So option-based income strategies really have become one of the fastest growing areas of not only the active ETF market, but just ETF market in general. What do you think is really driving that growth?
Yeah, I think it's a few different things. I think, first of all, you have individuals obviously looking for income. And I think it's also people thinking creatively outside of the traditional sources of income. It's folks that are maybe not so thrilled about the volatility of their fixed income investments over time, the low interest rate environment we've been in for a little bit of time, as well as just looking for ways to be more consistent in terms of how they receive their income.
So, you think there was advisors or investors or, they're kind of looking at traditional income investing and, they were looking for a way to kind of find a new way to, or basically trying to solve a problem that wasn't being solved by traditional fixed income.
Yeah, I mean, you've got tens of thousands of people retiring by the day at this point. And so I think historically what people always rely on is bond yields. And so if we're looking at, yields, like I mentioned, are relatively low, but choppy duration, whether you have to extend out a decent amount to get decent yields. It's just folks are looking for other ways to generate immediate cash as opposed to having to take duration risk in the portfolio, is my opinion, at least.
And so these products, I mean, I think a lot of investors that are new to this think that they're brand new, but they've been around for a little while. How do you think this category has evolved over the last decade?
It's evolved a ton. Our co-founders were some of the original guys involved in the ETF space in terms of covered call strategies. If you look back at how those were built versus how things have evolved to today, it's dramatically shifted over time. I think that's part of it is the structural change, but I think also there's a lot of comfort people have with strategies that are more options based. My own background was being involved in a lot of the buffered type defined outcome ETF space, and so this is another way to use a lot of those same tool sets to deliver income for folks. So I think you have a few different things at play, people looking for alternative sources of income, but people also becoming more comfortable with options. I think you have older folks who are now educated on what options do and how they work, and it's more comfort in that tool as opposed to feeling like that's a gambling device like people used to think back in the day. And I think you have a lot of younger people who are also very interested in self-educating in terms of how do options work, how can they be pieced together, and then turning around and relying on professional managers to do it for them.
Okay. And, I mean, obviously, there's a lot of more education right now. In terms of how the products are actually structured, what do you think the biggest differences are from, say, the first generation covered call products to, some of the products, including your firm and, others on the market right now?
Yeah, I would say, we were involved with some of the first generation as well, so it's no knock on those. But if you look back at how those were built, typically it was giving yourself a long equity exposure as the underlying base case, and then selling away all of your upside using calls. So those were fine, but the reality was that you typically gave up any opportunity for upside growth in the underlying by selling away 100% of the exposure at the money. And so really what we've done since then, and what I'd call generation 2.0 of covered calls, is selling less than 100% notional, ideally, in most market environments, out of the money. So you have a little bit of growth even on the part that is covered. And then lastly, very importantly, is becoming more tax efficient in how you structure the funds and make distributions. So I think those three in combination have just made this a much more attractive asset class than it was in the first generation.
That makes sense. I think, even a lot of listeners to this podcast are kind of new to options. And so for them that aren't options specialists, can you walk us through how, NEO structures these products, how they're created?
Sure. I'll start with the basic high income equity strategy because that's the asset class most people are familiar with. We've branched off well beyond that at this point, but as a baseline starting point, let's start there. So, what we do first is we do full replication of the S&P 500. So we actually buy all 500 or so names in the appropriate weightings to track that index, and then we sell calls, like I mentioned a second ago, out of the money. So we have a few levers we can pull. We sell them out of the money, ideally on less than 100% notional. And then each month that is adjusted accordingly to where's volatility in the marketplace, what distribution targets are we trying to make for the month as well as the year. And so it's a dynamic strategy that's really trying to give you some upside exposure in your underlying while still delivering predictable, reliable, tax efficient income.
And you have other strategies as well. Are they structured similarly or a little differently?
It depends on the part of the portfolio you're looking at. So we have the core equity strategies, which is S&P and Nasdaq. Those are really kind of our big flagship funds that everybody's familiar with and comfortable with. We have Russell, we have Developed International, and then if you look at the rest of the portfolio, we have 19 funds now. By the way, we have branched off into boosted equity. That gives you a little bit more of a levered exposure to the upside and enhanced um, distribution rates that are increased accordingly. And then we have a hedged line as well that takes some of that income and instead of passing along the full amount, we'll hold some of that back and purchase downside protection in the portfolio on a monthly basis as well. So that's for folks who are a little bit more defensive, but still want relatively high levels of income. And then we have fixed income is pretty much looking at let's hold some fixed income and try to enhance that marginally without adding significant duration risk or credit risk to that portfolio. And then lastly, alts. Alts has been a big area for us in terms of growth as well. And so within that are things like gold and Bitcoin, MLPs, real estate. So philosophically, we've tried to expand our lineup to cover all areas of the portfolio that are traditionally held by individuals and convert those into income production if possible.
No, I mean, definitely seems like, this is the way to go with a lot of firms are kind of, in this space, and so it's really interesting to hear about all the different strategies. And I know you mentioned this a little bit earlier, but tax efficiency is becoming an increasingly important topic in this category, and obviously a major part of the NEOS story. Why has it emerged as such a focus for your firm and even the greater industry?
Sure. Yeah. I mean, it's a common phrase people say, but it's not how much you make, it's how much you get to keep as well. And that's true for covered call funds. Like you wanna have really nice high levels of income, but you also want to be able to keep as much of that as possible. And so that's where it's really important to be tax efficient with these strategies. And that's where newer strategy design, even changes in tax treatment over time has evolved since these first came out. And so what we try to do is a couple different things to be tax efficient. We try to use 1256 contracts when possible. Those are index-based options that get 60/40 treatment. And then we also try to prioritize tax loss harvesting to generate return of capital at year end. And so return of capital is essentially a classification where you can go back and the outside parties say these distributions were return of capital. And those are tax deferred distributions, therefore. That does lower your cost basis, but it allows you to collect income on a tax deferred basis if we're able to tax loss harvest to generate those.
If we think about, what has the biggest impact on the tax characteristics, is it just kind of a combination, or do you think, one of those parts?
It's kind of path dependent, I would
Okay.
say. If we're in a major rising bull market, we sell our calls periodically. We sell them 7 weeks out. We roll them at the 4 week mark. If the markets have gone up dramatically, a lot of times those are going to be covered at losses. And so when we're covering those positions at losses, buying them back essentially, that generates losses throughout the year. And that's where you're seeing a major bull market year often has a pretty high return of capital figure to it. Last year, and these are publicly available, you can look it up. The SPY I fund was 95% return of capital and QQQI was 99. And so in a major up year, you're going to see those numbers be very high. I mention that because if you're in a flat year or down year, when it's not as easy to harvest losses for a good portion of the year, that's where that 1256 contract and 60/40 treatment really helps kick in as well. And so it kind of varies depending on where the market's headed, but there's a couple different tools we use.
If we go beyond tax considerations, what other do you think implementation decisions really matter most in NEOS strategies, that really kind of separates the firm?
Yeah, I would say kind of going back to the Gen 1 versus Gen 2, most of the early day covered call strategies were very, I would say, rigid in construction in terms of, every month we do this no matter what. And so that that meant originally selling all of your exposure to the upside at the money. That would be a good example of like a rigid strategy. What we try to do is more dynamic. Now, we still have rules to everything we do, but it's a much more dynamic strategy. And I'll give you a good example is that we have targeted distributions per month. And as you can imagine, when you enter a high volatility environment, let's say the market's selling off dramatically, that's usually when volatility spikes dramatically. A rigid strategy would say, we do this every month no matter what. Our strategy says, remember, our goal is to collect X percent per month. So if I use SPY, for example, we distribute about 1% a month. We're going to sell as little as we can, as far out of the money as we can to deliver that 1% premium. And so if I look back and say, well, like a high vol environment where the market's crashing, that's typically when we have a very low coverage ratio and it's farther out of the money than ever. So when you most want the ability to help recover with the market, that's what we're able to deliver by being dynamic. Now, the other end of that spectrum is a very low vol rising environment. We're going to end up covering a lot more of the position closer to the money. But by being dynamic, it really helps you recover more quickly during a major market sell-off.
There's an argument that, are these type of strategies considered active management? And, we classify them at Bloomberg as active strategies. When I look into active, I kind of cut it up between traditional security selection and then what I call new active is, these type of strategies. So I do consider them active. So I guess, where does active management play a role? I know you mentioned they're rules based, but is there also like a discretionary part of it depending on the market environment?
There is somewhat, but we're fairly transparent with how we make our distribution targets. If you go on our site, you'll see that every one of our products has a separate distribution target range. That's a range for one, so there is some variability within there. But second, we are managing the funds to hit those distribution target ranges, and so there is some decision making there, but for us, we know with a pretty high level of certainty how much do we need to deliver each month to meet this expectation. And so it's really only a few levers we're able to pull, and that's moneyness, notional coverage, and then how far out we write, which is systematized on our side. So there's only a couple things that we're truly active on, but there is some nuance there in terms of how far out of the money and what percentage we cover on a monthly basis.
And, when you're designing an options income strategy, what do you think the most important trade-offs are between income, upside participation, and risk management?
hmm Yeah, it's a great question. I think this is something that I've dealt with both here at NEOS as well as my past life with anything that's options construction. And I feel like I say this a lot, but there's no free lunch with options. Every single payoff you could construct, no matter what you're trying to do, floors, buffers, caps, participation, income strategies, there's a fair trade-off for what you're receiving in exchange for what you're giving up with an option. And so I think from a construction standpoint, to your question, it's very important for somebody to be very thoughtful about what it is they're trying to deliver to the marketplace. For us, it's a priority to try to have high levels of sustainable income that are tax efficient, but we also want to allow people to have some upside in the market. And so for us, it's important to always have some portion that's not covered in terms of our exposure. We also are very strategic in how we pick our distribution targets. We have competitors on both sides that are, more conservative in terms of distributing less income. We have some that are far more aggressive in terms of very high levels of distributions. The trouble with very high levels of distributions means you could very quickly erode your NAV of your fund. And so we really do prioritize trying to maintain or grow NAV, over a full market cycle and to be able to continue to make the high levels of income over time. I do think it's important to be thoughtful about how you put all the pieces together. And not just that, but also help educate people and really message very clearly what it is you're trying to accomplish and why you're structuring the funds the way you are.
So if we actually go there and think about the other side, how do you think investors should think about? You covered how you think about when you're actually creating the strategies, but how should
Mhm.
investors think about those trade-offs? When they're thinking about their portfolios, what actually advisor or
Sure.
investors?
Yeah, it's an interesting question because let's just take our high equity income or high income equity, I should say. And if I compare that to fixed income, which is kind of a traditional alternative to generate income, or dividend stocks or annuities, things like that, other ways to generate income, it's interesting because we're basing it off of equity, but at the same time, somebody shouldn't come in expecting to have a price return that looks just like equity. I think it's important to think about what we do from a total return standpoint, just like any investment. If you look at bonds in general, I'm oversimplifying here, but if you get bonds don't generally have a strong price appreciation element to them. They might if you're buying distressed debt or something, but if you're buying a bond at issuance, you expect to get that back later, but you're also very aware of your total return, which is the combination of price return and distributions. And we view our strategy the same way. It's important to look at ours from a total return standpoint in terms of how they perform and hold up. It's really up to the individual whether or not they live off that income or reinvest that in certain market environments. But for us, we're trying to generate very high levels of total return relative to the underlying while still prioritizing that high level of income.
So then, what do you think the biggest mistakes investors make when they're comparing different types of option income ETFs, but they're just looking at distribution rates or yields?
Sure. Yeah, I think the yield trap is very much real. I used to be in the bond world, and the yield trap was very true there as well. As if there's an extremely high level of yield, there's usually a reason for that. And we've seen that a little bit in the space as well. There have been some strategies that have had very high levels of yield that have quickly depreciated from a NAV standpoint. And I think it's important for people to know what that trade-off is and how a firm is running their funds and what the expectation is of how sustainable is this income generation over time.
So then, if we go a step further and think about the relationship between the yield, you're looking at total return, but then what about after-tax incomes? What should
Uh-huh.
advisors and investors really be thinking about that relationship?
Yeah, I think that's a huge selling point for strategies like ours is really understanding that, if I have two funds that distribute 12%, similar to our SPY fund, but one of them is run kind of the old school way, which is a lot of those distributions are ordinary income. The majority are. The after-tax impact of those two is dramatic between those. And we spend a lot of time with advisors looking at their portfolios, looking at how do they achieve whatever level of income it is they're trying to achieve using our funds. And if you're very tax efficient, you can actually use less in a strategy like ours. Not that that helps us, but you can be a little bit more strategic and judicious with how you allocate to this if it's done properly. I think the challenge would be, and obviously we're on Bloomberg here. If I go into my Bloomberg and I look at returns, even total return, since every individual has a different tax situation, there isn't a way for me to see after-tax returns. I'd love to be able to show our returns on an after-tax basis year by year. That's hard to do, but it is something to be aware of. Is just to say, if I can get 95% return of capital or 99% return of capital, that's a really attractive after-tax return versus some of the alternatives that are out there.
And when you're speaking to advisors, how are they using the NEOS strategies in their portfolios today? I mean, are they treating them as equity income, fixed income alternatives themselves, or something else, and completely entirely?
Yeah, I would say all of the above. I think if you look at flows, a lot of our flows are concentrated in those high income equity sleeves, as you'd expect, which is like SPY and NASDAQ. Um, but as I mentioned, we've expanded that to every part of the portfolio. And a lot of that has been driven by investor feedback and allocators saying, I really love equity covered calls, but I'd also like to generate income from these other parts of the portfolio. Bitcoin's an interesting one from that standpoint. Gold's another one where people say, I like gold, or I feel pressure to own gold because it's had a historic run, but I'd rather this be an income generating asset class for me than just something I hold on to and hope it continues to go up or offers non-correlation benefits. And so that's a lot of why we've brought products to market that we have, is trying to fulfill income needs in other areas of the portfolio for folks as well. So to answer your question, I would say it does vary a lot. We have quite a few people that generate income from areas of the portfolio that aren't just equity, given what we've built.
Are you seeing clients using, or your advisors using these as replacements, or kind of as say you have one fund and you want to use one of your strategies, going half and half? Do you see that
Mhm.
at all?
Yeah, definitely. You mean in terms of plain beta or in terms of competitor?
Well, no, I mean, like if someone has just a beta, say like
Sure.
a beta, an
Mhm.
equity beta, whether it's large caps or something like that, instead of replacing it completely with one of
Yeah.
the option strategies, kind of going half and
Mhm.
half. Do you see that happen?
Yeah, definitely. We definitely see that scenario. And the reality is not everybody needs 10 to 12% distributions a year, or 13 to 15, or 25 to 30 for a Bitcoin or something like that. Like, some of these funds have very high levels of distribution. And so the reality is people don't need that much income typically. But that's nice because it allows you to generate the income you do need with the portion of your portfolio and leave a portion of it in, pure cheap beta to get that upside exposure as well. And so we do view these, and people view these as very efficient tools to meet income demands while not taking up the majority of their portfolio. I think, just to go back to old school, like with the glide path scenario, somebody in retirement, they were putting a ton of their money into bonds to generate the income they needed back in the day. And without taking dramatic credit risk or duration risk, now you can meet those income needs with a much smaller allocation, which has been pretty attractive to people.
Are there any scenarios where these type of strategies can be misused?
Um, I wouldn't say misuse. I think the biggest thing to keep in mind is kind of like I mentioned earlier, is just understanding what you're getting with any options package. Like, understand that there's a trade-off. Understand that you're not going to get the full upside of the market if we have a major right tail event. That that being said, there are times when you have a moderate market, we'll say, up 1% or 2 a month. You might get all of that with this and still have those calls be just out of the money at that point at the end of the month. And so there are scenarios where this works well and you'll get a lot of the upside. There's other scenarios where you have a major right tail event where there is going to be a give up. So I think, for me, I wouldn't say misuse. It's just making sure people understand that there is a trade-off where we're prioritizing income over giving you full upside participation.
Do you think there's anything that investors misunderstand about NEOS's strategies, or actually just option income ETFs in general?
Um, I don't know if it's any major misunderstanding as much as I mentioned, people just need to understand what that trade-off is, and that might look more like a total return play as opposed to a price appreciation play. So as I mentioned earlier, our price does appreciate somewhat in a normal bull market, but that's not our priority. Our priority is to make sure people have distributed income that they can live off of tax efficiently. And so if you look at it from a total return standpoint, it looks pretty similar in many market conditions. But the makeup of those two pieces might be different than they expect versus just buying cheap beta with almost no income on it.
Okay. And, if we look ahead, maybe 5 years or so, obviously this part of the market's really exploding right now. Where do you think the next phase of innovation is, whether it's NEOS or, even just the market in general in terms of these type of strategies?
Sure. Yeah, I mean, we've seen a lot of competitors come to market, which is flattering that people have adopted this idea of there's a better way to do covered calls. I think for us, it's continuing to look at our lineup and figure out where are there gaps. Um, we try to be very thoughtful when we bring something to market, that we want to make sure it's not something that's too short-term trendy, or more importantly, that there's significant options liquidity there. In the long term, we want to make sure our market making partners are comfortable, and that the clients are going to have a good experience because of that. So for us, it's really filling out the lineup in terms of what are other areas we can generate income that are sustainable, and that this is a 10, 20, 50-year product as opposed to a short-term product. So that's how we think about it. And I expect other people will do more of the same.
Oh, well, it's something to look forward to. But no, this was an interesting conversation. I come from the traditional security selection world, so I'm learning more and more about these products every day. And, this is fun to talk about. But I appreciate you coming on, Wes. Thank you so much for joining me.
Yeah. Thanks, David. Appreciate it.
And I also want to thank our listeners. If you like the episode, please share it, subscribe, and leave a review. And if you'd like to see more of our research on the terminal, go to BI Fund Go for fund and active research. Until our next episode, this is David Cohne with Inside Active.
Healthcare doesn't always work great. If you've ever waited on a refill or couldn't schedule an appointment, you get it. That's the kind of stuff Optum is changing. They're using data and technology to integrate patient care, pharmacy, and everything else, so healthcare is connected, not complicated. What's that look like? Cheaper prescriptions that are easier to get and care that looks at the whole person, how you need it. Optum is helping make healthcare work as one for everyone. Learn more at business.optum.com.
Wise is the smart way to manage the currencies you need around the globe. When you send money abroad using your bank, you could get hit with hidden fees and exchange rate markups. There's a better way. Try Wise. Wise uses the exchange rate you'd usually find on Google, with no unwelcome surprises. Plus, most transfers happen in under 20 seconds, which means your money arrives in less time than you've been listening to me. It's simple and free to sign up when you download the Wise app. Be smart. Get Wise. T's and C's apply.
You know what quality feels like. You can see it in the way a fabric moves, recognize it in a flawless fit, and appreciate it in the details that make our styles unique. It's the standard Coldwater Creek has honored for over 40 years, derived from a rich Mountain West heritage, and designed for today in styles that are distinctively Coldwater Creek. For a wardrobe you can count on season after season, visit coldwatercreek.com. Shop new arrivals and save 15% on purchases $75 or more with code IHEART.